This is the Friday, February 27th, 2015 version of the Market Plus segment. Joining us now is Don Roose. Don, welcome back.
Thank you, Mike.
Now, of course, we are taping this show on February 27th, the last weekday in February, which means we can now figure out crop insurance rates. Talk to us a little bit about what we're looking at this year, maybe versus last year or 2012. It's a little different picture.
It is different. We're starting out with insurance rates that are going to be substantially lower than a year ago. Corn is going to be close to almost 50 cents lower than a year ago. A year ago, we were $4.62 on our price. We're probably going to be somewhere closer to $4.15 on corn. Soybeans, very similar. Probably a year ago, we were $11.36, probably going to be closer to $9.70, so $1.50 lower. So I think what it really means is probably more important than ever to make sure you have some kind of solid risk marketing strategy on your crop that you're growing.
Yeah, we've got less revenue to protect. We need to manage it more aggressively. Now, I'm just kind of doing quick numbers in my head. It looks like on the insurance levels, we're pretty darn close to that 2.4 corn-soybean ratio, aren't we? 415 to 970?
Yeah, if you on that one, but if you look at it, it's really more like 2.4 is a pretty good ratio. But if you look at 350 corn on average, you would need soybeans would be closer to $8.05. So if you look at it from a ratio standpoint, the soybeans are still substantially overvalued versus the corn. So if corn comes down 70 cents, the soybean market can come down probably close to $2.
Well, and that kind of leads right into a lot of the questions we've got here from our Facebook and Twitter followers. I want to begin with DW in Tennessee. Ask the question just straight out, will beans go to $8 by fall?
If the fundamentals take over, I think that they do, actually. And the government's saying pretty much the same thing. But there's a series of events that we have to get through first. And one, we have to figure out what the acres are going to be. We had to figure out what the weather's going to be and what we're going to get for a yield. But if all the cards and all the stars line up, I think with a big crop out of South America and a potential large crop here, the soybeans have the most downside potential. And I think the question mark is if can $8 actually hold us, or is it lower than that?
That's not a tantalizing prospect for guys who are thinking, I want to cut my input costs, put some beans in the ground, and sub $8 isn't very attractive.
Well, when you look at South America alone versus last year, their production is going to be up probably between 1.1 and 1.2 billion bushels larger than last year. So that's what you're really dealing with. You're dealing with a carryout here in the U.S. is 430 million now, and that's using some pretty aggressive demand numbers, pretty conservative yield, and acres that are probably a little bit small. You could be have a carryout there that's between 550 and 600 million. So these numbers are really, they're really quite shocking if you're thinking positive. You're going to have to get bailed out to the upside on weather issues, I think, is really going to be the story down the road.
And it's an interesting, we mentioned the Brazilian trucker strike being an issue in South America. There's also tremendous amount of political and economic issues in Argentina. Farmers under fire for holding on to beans, and the government wants them to get them sold. I don't know how big a factor that is long-term fundamentally, but it's an interesting story to keep an eye on down there.
Well, yeah, I mean, and that's the issue, and that's why, we wonder why China, the largest soybean buyer in the world, why they double book, why they buy option origin, and these are the reasons, because the United States has always been a reliable supplier, where we have some of our competition has had some issues at times. So it's up to them to make sure that they can be a reliable supplier. If not, we come to the U.S. And that's really what's happened, and that's really what supported the soybean market, is because we have a demand that just hasn't shut off like we thought it would because of these issues.
All right. Now, you mentioned acres. We've got a question from Phil in Ontario, and we've heard a lot of discussion on acres. Informa said we might see 4 million extra bean acres. USDA says we might see a little bit less than last year. And Phil's question is the USDA's estimate of soybean acres going to be reality, or are we going to have to wait until March 31st or June 30th to confirm it? I mean, what's your take on this market? Do you think we see more bean acres, or do we look at maybe is the USDA closer to correct, in your opinion?
I think when you look at it, probably the acres go up. And I think it starts with the fact that the government, in their outlook, when they put out their acre estimates and stuff, they're reduced the overall acres versus a year ago down in the 4 major crops, soybeans, cotton, wheat, and corn. They reduced them 4.4 million acres. Now, why? And I think what you're going to find is you're going to find a couple million of those acres go back into soybeans, you know, maybe even 3 million. So I think some of the private forecasters that are up higher than the USDA are probably more right. To have the acres on corn be down 1.6 million and the bean acres be down 200,000 versus a year ago, I think just doesn't make sense, you know, from our standpoint. But we'll see how the weather goes. That's probably going to be an issue also.
All right. Now, we had a question on the cattle market, the fat cattle trade, watching Friday's incredible final hour of trading where we rose nearly $2. Chart Boy in Southwest Iowa on Twitter is curious, what does that close tell us? Does that look like we might be pushing to that technical level in April cattle market at that 154 level? Do you think we're going to head higher based on that strength?
Well, what we had this week is the funds were too short. The trade, we were oversold. We had a weekly reversal when we got close to 145. We couldn't hold it. We pushed to the upside. It's a positive sign, but I think it's a market that now is a little bit overbought. 154, 155 is really tough resistance, and if something doesn't change fundamentally, I think that probably is going to hold us with an outside shot at 158.
Okay. All right, now, Don, before we let you go, we've seen crude oil be relatively stable. We've got a lot of folks who are still waiting to get their fuel needs booked, their farm diesel needs booked for this next year. What are your thoughts? Do you just pull the trigger down here with where we're at and get some fuel needs locked in?
Well, we're still in a supply bear market on the crude oil for all the issues. Our demand is less and our supplies are larger. And I think rather than locking in tight supplies in a bear market, I would be more interested in using some risk management strategies with options and doing the same thing, giving yourself a chance to have some downside potential. You can do it with heating oil options.
All right. All right, Don. Well, thank you so much for taking the time to join us this week.
Thank you, Mike.
And thanks to all of you for sending in your questions via Facebook and Twitter. Please continue to do so. Please tell your friends to tune in, and we will get expert market analysis right to you. Thanks for watching, and have a great week.